HMO licensing rules have recently changed. Can you give us your view on how that should impact on the market?
Yeah, so some research has been done, and there's 163,000 existing licence holders for HMOs. So it's understanding what the situation will be and the complications and implications they might foresee, but also just the standard generic factors. Basically, you're going to have minimum room sizes. The 3-storey rule or element is being removed. So the licence will be applicable basically if there's 5 or more individuals not related to one another will require a HMO licence. Issues for investors would probably be delays in actually getting approval for licensing. How that will impact their costs and their strategy for funding, I don't know. It's something they need to factor in. At Shawbrook, we're quite market leading on our approach on this because most people have to be a fit and proper person, and most people who are existing licence holders, if they've already applied for a new licence for a new property, will probably continue to lend, knowing full well the application's gone in because they've already hold a licence. The likelihood is they'll get another licence, and with the due diligence we do on these clients as well, we're quite comfortable on that fact. However, if they're not an existing licence holder, then unfortunately the current policy, and I think most other lenders are, you would need to get a licence on this property in your name to be able to get funding.
And I think that poses an interesting point there. I mean, you've probably got quite a lot of applications live at the moment where landlords thought they had enough time to put the licence request in, get authorised before the drawdown of the loan. But actually, you know, the backlog of licence applications that local council and local authorities are currently experiencing, I think, are going to cause further delays to customers looking to refinance or purchase with applications pending before the October deadline. So, you know, people have really got to take this seriously and make sure things like valuations won't go out of date, offers don't expire. So there's a lot to consider here, and we've certainly been inundated with a few questions regarding that since the end of the month.
This rule was passed in February. Do you think landlords knew enough about this in advance?
I generally don't think they did know. I think if you actually trace back the legislation since February, there's been multiple white papers in circulation. I mean, you even look at the gov.gov website today, and there's conflicting information still with old data on there. So no, I don't think there's enough knowledge, and I don't think there's been enough awareness leading to this date, and it's quite alarming really. I mean, although it's not a massive change in terms of the definition ruling, the process of actually mandatory licensing is a big hiccup because you're putting your hands again you're putting your property in the hands of a third party, being the council, to approve that licence. So, you know, I think the government could have done a bit more with regards to awareness leading up to this point, and making sure all their HMO and licensing .gov websites were clear about this process well before that, and they're still out of date.
Yeah, I agree. I think also with regards to the licensing part, the room sizes that have been published as well, I think people haven't been aware. I think there was not as much clarity around it. There's still, even now, I mean, you look through the regulation and the room sizes that need to be published, there's quite a few different hard and fast set rules, depending on the age of the tenant and 1 or 2 persons and so on. So there's quite a lot of different sort of new legislation that people for the licensing need to understand. I think the point as well is the delays will actually, you need to factor this into your cost in your project now, because no one knows how long the delays are going to be for, but clearly there will be delays because people are going to have to apply for these licenses. Now, if you have someone on a short-term offering that's already through that process, and as a bank, you want, obviously, or a lender, you want to be looking at sort of solutions to either refinance that offering or obviously be redeemed from your book. If that is going to cause delays, and that may even result in a default position for a client. That's where banks and lenders need to be slightly sensitive to this fact as well for clients.
The government white paper talked about overcrowding as being the key driver for this, that they wanted to improve the standards. Other commentaries around that this is another attempt to professionalise the buy-to-let market. Do you have any thoughts around that?
I think overcrowding is a genuine concern. You know, we don't want to see any human rights violations. We as a business, you know, we've seen all sorts. People sleeping under stairs with mattresses, in cupboards, and they're paying weekly rents to landlords. You know, that's just unacceptable, really. You know, no human being should expect to be paying for a prison cell, basically. However, I think the time could have been a lot better. I think there's a lot of change within the professional investment sector that's sort of happened over the last 2 years, and this just seems to be another sledgehammer to sort of quell further growth.
Yeah, I agree. I mean, we've actually seen quite a change in the shift for sort of the quality of HMOs. We've always been part of the sort of professional landlord investor journey anyway since day one of Shawbrook, and the quality of HMOs, we've always been quite keen to make sure our clients maintain a high level of quality. The quality is evolving, it's changing. I think, like Joe rightly said, there has been quite rightly highlighted in press and landlords being fined of some of the sort of misdemeanours that have got on, but actually you're seeing more professional people using this as a viable alternative. Landlords are realising this, making sure you have the right sort of people aligned with each other, right tenant profiles, offering little things from satellite TV, Wi-Fi, all the extra additional bonuses and benefits that people have to drive a better tenant profile, but also to make en-suites available and so on. So there is a genuine drive to have a more quality accommodation, but I do think its timing is another part, which Joe said quite rightly, is probably another bit of a kick for landlords. It was coming, it needed to come in, and I think it's actually will professionalise especially the HMO sector further.
And look, I mean, let's not forget the buy-to-let taxation rules that came into play this fiscal year has caused a lot of professional landlords to change their model. You know, they changed their focus from TURP 2 down, standard resi, seeking yield through either capital growth or rental yield, and HMOs naturally have provided a good solution to their problem, i.e. how do I earn more from the same bricks and mortar. So this piece of legislation was always the natural follow-up for me. You know, taking a 3 or 4 bedroomed house and turning it to a 5 bedroom HMO without cramping any of the individuals, I think does need to be regulated. Although I think sort of the below the radar way this has gone about has been a little bit unfair on what are good quality landlords in this sector.
We've certainly seen an increase in demand from the more professional HMO landlord recently, even with wealth managers or process managers getting involved and handling the whole process. Would you still think that HMO investment is a good investment option for clients?
Yeah, I think Joe touched on it a moment ago with the PRA changes. The multi-tenant nature of a HMO means that you're going to get stronger cash flows, and it makes it more viable and sort of future-proof investment. There is a lot of HMO mentorship programs, gurus in the marketplace and so on. Again, it boils down to the fact that actually it's always a sound leveraged investment is property, and the fact that the PRA changes have come into play and the fact that the Section 24 changes means that actually investors are going to have to look for higher yielding properties, and HMOs, which was probably classed as a more specialist asset class for an investor to manage and maintain and obviously leverage against, is actually quite a simple solution now. I think a lot of first time investors are looking in it for an opportunity to create cash flow, to create a business model and move forward in that sector, rather than the 3-bed semi-detached on a lower yielding basis.
Gavin, Shawbrook have been market leading on their definition of HMO valuations, and on your website there's quite a clear guide to how you consider it. It's still one of the hot topics we get from brokers today, asking exactly how a lender views and will value a HMO. Can you give us some comment on that?
Yeah, certainly. I mean, it's quite a hot topic whenever we attend any sort of client-facing meetings as well, is this differentiating between what is an investment value on an HMO. There's a lot of people that just assume that if it yields at 10% you can times that by 12 and this is how much it's worth and so on. So we've clearly got our 4 steps defined, 1 to 4. So the HMO 1 is basically, it's quite a simple scenario. It's based on private dwelling value. You have a property that's worth £100,000, it will cost £10,000-15,000 to convert it into a HMO, but it's minimal works and it's there for a HMO. Would you pay a premium? And is that property now worth 150, 170? Probably not. I could probably buy a similar house in the same street, spend £10,000 and have the same model. So I think that's where you have to be careful. HMO2 is slightly different how we value it. We work on market value here. there wouldn't be any article for or planning, but what you'd look at is a client would have undertaken some significant changes to the property. So probably adding on suites, for example, and therefore it is more deemed viable that is actually probably a value would look at it and go, yeah, there'd be a demand here and this could be used as a HMO. You would add an element of premium to that, but you'd still work off pretty much a bricks and mortar value, but a slight uplift in premium because of the en-suites. HMO 3, nice and simple. Is it an Article 4? Yes, therefore planning was required. Therefore, it would have good demand and be viable as a HMO. Therefore, you could look at sort of justifying the price and the premium to be paid. And then HMO 4, large HMOs, sui generis, then yeah, you can look at a sort of market value with an element of investment value added to that as well. But again, it's all down to values interpretation and also being able to manage clients' expectations at the initial outset as well. Because there is a lot of advice out there that's been given to how you value HMOs, but we've clearly defined ours aligned with RICS on that.
And then to finish off on HMOs, what are your thoughts on the future of the HMO market?
I mean, I personally think that it's an engine that's just going to keep on grinding out more results because of the yield, because of the PRA changes. I think it's an attractive investment proposition. I kind of feel that a lot of investors are finding their feet in this sector now, and the natural evolution for them is to focus a bit more on commercial HMOs, so bigger, with greater yields. You know, we've seen a lot of PD conversion from semi-commercial or full commercial into 20-bed HMOs with affordable living on the ground floor, and I think that's sort of the next step. If I was in HMOs right now and I was doing your standard 4 or 5, 6-bed HMO piece, you know, I'd be trying to get to that next stage of commercial HMOs as soon as possible, and we're reflecting that in what we're seeing, you know, demand as a business at the moment.
I agree. I think basically there's the classic supply and demand issue in this country. I think people's lifestyle choices, and obviously for social reasons, it helps with lower rents and so on. So I think the future's bright for HMOs. I think there's high-end quality HMOs out there now that are available. I think 37% of people choose to share for social reasons as well. So there's a growing factor. I agree with the commercial permitted development part. There's a lot of property out there with space or void above that people can start maximising as well, and I think it will continue to grow. Like anything, the investors are clever and shrewd in this space and will always try and maximise profit and also look at opportunity.
We're seeing a trend from lenders at the moment moving towards the light refurbishment market. What were your comments on that?
Again, I think your analysis is correct. You know, we in the last 4 weeks have had 2 great Refurb-to-Let products added to our panel, Shawbrook being one of them, and a Wolverhampton-based lender with the other one, which is another exclusive with Crystal. I think it fits a massive need. I think landlords are, you know, investors are sort of getting into this market now, not having enough funds to cover off refurb costs, so they're going to need higher LTVs day one. The Shawbrook Refurb-to-Let product absolutely fits with that, and I think we'll see a growing trend of short-term lenders following suit because there is strong demand. You just need to make sure you're working with a lender who's got that expertise in knowing what the end product should look and feel like, so you're not caught with potentially a bit of a white elephant HMO at the end of it all.
Yeah, I think the space is evolving. There's been a few market-leading sort of products. Our Bridge-to-Let offering with the funding for costs has been really popular. It's about cash flow, right? The changes to stamp duty. People are having to find a bigger cash pot required to complete these projects. But in essence, our product allows you to gear to 85% day one, provided you don't exceed 70% of the GDV. Now this allows, I don't know, if you choose a typical purchase 3-bed property worth about 425, usually spend on that would probably be about 50k. You could look at ourselves, would be funding day one, probably about 361, which is almost sort of circa 85%. Investors still going to need to put in with stamp and deposit, and probably the remaining refurb costs are about 137k, so there's a large cash flow required. But then you have that bridge to let scenario where you can then replenish that cash pot, where the client can look to refinance with ourselves, for example, for 0 arrangement fee, leverage on the new GDV for no arrangement fee on any additional borrowings as well, use the same surveyor to make it a more succinct process, and then move on to the next process by releasing some of that capital out of that deal as well.
Perfect. Absolutely suits the need. You know, we've had great uptake with that product. and I think we'll see more and probably better product innovation in terms of the single underwrite product moving forwards.
So during the course of the conversation, we've touched on the asset quality. How important is knowing your customer during this process?
Yeah, I think it's key. Yes, lenders have a more wider product offering, so clearly they understand that this is a growing space and there's a lot of new investors looking into it. But I think clients need to be experienced as well and have the right support network around them. We work closely with yourselves with some specific HMO sort of mentor programs which will help source, create, manage and offer the long-term solutions for all of that, and that's something that's key to this because there are multiple tenants involved, and having to make sure you've got the right support network in something that can be quite heavy maintenance from a time perspective is key. Also, you have a lot of expats at the moment looking into this sector as well, and obviously if they're based in Singapore working abroad, you're going to need to have the right management team running these HMOs for you, making sure you get the right tenant profile, making sure there's no breach in planning, etc. And we're definitely seeing more of that, but I think it's key to this journey piece as well. And for example, with ourselves, we would look for someone to have experience in this sector. We wouldn't lend to first-time HMO investors.
Yeah, I mean, I absolutely agree. I think sensible, prudent lending and sensible ownership comes from how good the managing agent is and the profile of the tenants in there. It's often attractive to get higher yields from DSS or state-provided leases on HMOs, but you're really restricting A, the quality of lender you're going to partner up with, and B, the state of the property when you eventually get it back. A lot of people forget this and they're sort of drawn by the white lights of the pounds, but what they don't realise is in the long term it's going to cost them a lot more with higher interest rates and additional unforeseen refurb costs that a lot of these contracts bring with them. You do get FRI, fully repair and insuring leases in this sector, but still, we as a business have seen properties that need bridging loans after they've had a certain profile of tenants in. So, partnering up with the right managing agent, just like you partner up with the right builder to convert the property, is absolutely key. One of our top clients are the Mahans of Intelligent Wealth Management. They work with a lot of HMO clients throughout the UK, and they manage the process from source, build, and then they're there day to day to collect the rents as well. So, having people who have experienced and got a proven track record within this sector, and by the way, just because they're good at the smaller HMOs doesn't mean they're particularly good at the commercial ones either. So make sure that even if you do change your model, you're partnering up with the expertise that you need to get the yields that you're looking for at the end of the year is absolutely crucial.
I think on that partnership as well, is if you get the right management team in place as well, it's about knowing the area and knowing what sort of tenant profile, what demand there's going to be, what future changes there might be. You may have great demand now, but actually the local hospital is going to be closing in 2 years' time and relocating, or the local university campus is going to be relocating. So actually the demand for your property may fall, and to have that expertise and knowledge in the area is key as well for clients on this journey. It's easy to get the funding, but it's easier if you have the right team around you to help manage you through the cradle to grave scenario.
Just one final point that you just alerted me to there actually as well is, if you've got the right team, they will find the right tenant. Again, not only the council contracts seem to be very attractive, but the university-led contracts seem to be very attractive as well. Again, think about the condition of the property that you're going to be getting it back in at the end of the 12-month licence period. What costs that's going to hit you for when you've got to refurb and put new carpets here, there and everywhere. It's essential. These things are often overlooked, and lenders have seen it all before, and they'll ask the question, and ultimately if there's a risk to the lender that they're going to get the property back in that state, that'll be reflected in the pricing accordingly. So it's only going to cost the end user as a result.